In this video, we'll explore about exchange surveillance mechanisms like GSM and ASM. The stock market is designed to be a transparent place where buyers and sellers determine the fair price of a stock. However, sometimes traders use unscrupulous practices to distort these prices, which harms honest investors like you. To stop this, SEBI and the stock exchanges act as a shield. They monitor stocks based on objective criteria. If they spot something suspicious, they impose restrictions to protect the integrity of the market. Let us first look at the graded surveillance measures or GSM. This mechanism focuses specifically on companies that have a low market capitalization or low net worth. The core issue here is a mismatch. If a company's stock price valuation is high, but its business fundamentals are weak, it falls into the GSM funnel shown on the screen. The goal is twofold. First, to alert investors like you to be cautious. Second, to advise market participants to do extra due diligence. Depending on the severity, the surveillance can trigger restrictions like requiring a surveillance deposit, reducing the price band, or freezing the price on the upside. So, what exactly gets a security put into this GSM category? There are strict inclusion criteria based on the company's financial health. In scenario A, we look for companies with a net worth of less than or equal to 10 crores and net fixed assets of less than or equal to 25 crores. If such a company has a negative price to earnings ratio or a PE that is 2 times the benchmark index, it gets flagged. However, there are important exemptions. Public sector units, stocks that are part of an index, and companies that have paid dividends in the last 3 years are generally safe from being placed under GSM. Now, let us move to the second mechanism called additional surveillance measures or ASM. While GSM looks at valuation, ASM looks at volatility. It identifies stocks based on wild swings in price and volume. Look at the dials on the screen. The regulators monitor price variation between high and low points over 3 months. They track closing price variations over 1 month, 60 days, or 365 days. They also check client concentration to see if the top 25 clients are trading a huge percentage of the volume. If a stock shows abnormal surges in any of these areas, it gets shortlisted. Once a stock is caught in the ASM net, the regulators apply what we call the squeeze. The primary tool here is increasing the margin requirements. As you can see on the chart, if the criteria are met, the margin needed to trade, that stock can jump to 80% or even 100%. This makes it expensive for speculators to trade, which helps cool down the volatility. The price bands are also narrowed to restrict movement. However, similar to GSM, there are exemptions for public sector units and securities that are already available in the derivative segment. Changing tracks. Let us discuss the Advertisement Code. As a research analyst, you need to know what counts as an advertisement. It is not just a TV commercial. As the diagram shows, it covers print media like pamphlets and research reports. It covers digital channels like SMS, email, and social media. It also includes broadcasts on radio and video. A crucial note you must remember is that even a standard research report is considered an advertisement if it expressly or impliedly promotes a product or service. When you create an advertisement, the layout is strictly regulated. Look at the mock advertisement on the screen. The top section must clearly display the name, SEBI registration number, registered address, and corporate identity number. The body text must be accurate and concise. Most importantly, you must include the standard warning which says investment in securities market is subject to market risks. Read all the related documents carefully before investing. For audio or video ads, this warning must be audible and clear. The rule is specific. It should consist of 20 words spoken over at least 10 seconds. There are also strict prohibitions on what you cannot say. You cannot use false or misleading statements. You are strictly forbidden from using superlatives like best, number one, or top advisor. Unless you have won an independent award, you cannot make guarantees of risk-free returns. Testimonials are also banned if they are deceptive. Furthermore, you cannot claim a service is free unless it is actually free without any conditions. And finally, you generally cannot refer to past performance to solicit new clients. Compliance does not end with just the content. It is also about the process. Before you issue an ad, you need pre-issue approval from a supervisory body like BASL. During your operations, remember that you cannot run games, leagues, or competitions with prizes to attract clients. If you are ever suspended by SEBI, you are prohibited from issuing any advertisements during that period. And regarding post-issue compliance, you must maintain a record of every advertisement you release for a period of 5 years. Your brand name and logo usage also requires transparency. You must display your SEBI registered name, logo, and registration number on all public facing platforms. This includes your website, notice board, KYC forms, and client agreements. For correspondence like emails, you must also list the details of your compliance officer and grievance officer. Additionally, you must display a standard disclaimer stating that SEBI registration does not guarantee performance or returns. Note that while you can use your own logo, you are strictly prohibited from using the SEBI logo. To ensure you treat clients fairly, SEBI has introduced the Investor Charter. This document details the services, rights, and responsibilities of the investor. You must provide this to every client during the onboarding process and display it on your website. Alongside this, you must have a clear grievance redressal mechanism. You are required to publish the status of complaints on your website in a specific format. You must also provide a direct link for clients to lodge complaints, including a link to SEBI's own complaint platform called Scores. Finally, let us look at the Cybersecurity and Cyber Resilience Framework, or CSCRF. In the digital age, protecting data is critical. This framework is built on 5 goals. Anticipate means being prepared for attacks. Withstand means continuing your essential functions even during an attack. Contain means isolating the problem so it does not spread. Recover means restoring your systems to normal as fast as possible. And evolve means learning from the attack to minimize future impact. This framework applies differently depending on the size of the entity. As you can see on the pyramid, market infrastructure institutions are at level 1, requiring the highest security. Most research analysts fall into level 5 or the self-certification category. Generally, research analysts not registered in other categories are excluded from the full submission. However, if you use software as a service or SaaS for your governance and risk compliance, you must submit a declaration confirming you are maintaining a strong cybersecurity posture.